All right, good evening, everyone. Welcome to our today's session. So we're talking about advanced market mechanics, right? I think in the course of our last class, we have discussed everything we need to discuss, be it that of the advanced market structure, complex liquidity. So now we're talking about advanced market mechanics. Now, after advanced market mechanics, our next class is going to be advanced liquidity and many other advanced stuffs you need to know about. But take for instance, like don't worry, when we get there, we get to know about them. But those classes won't be recorded. All right, those classes will be recorded. If you want to go deeper, then message me on, wherever to advance your class. But for those in Cryptverse, you will be having those classes together. So with that being said, let's get started with our advanced market mechanics. Now, all these our days so far, if you are following from day one up to now, I think you pretty much by now have what you need to start killing the markets, right? Now, those other stuff, like I said, they are advanced. It means that you don't actually need them that much. You don't actually need that much, right? With what you have learned, that you can actually get those stuffs by yourself by studying the market. That's why it's called advanced. It's an advance because you can advance by yourself to actually get those stuff without being taught. So with that being said, let's get started with our class today. So talking about market mechanics. Now, in market mechanics, these are the 40s we're talking about. The theory behind our points of interest, which are your components of market mechanics. Then we talk about the validation of your points of interest. Then after which we talk about the order of points of interest. Now, this time around, we're talking about the advanced PDRA, more or less, and we'll be making use of just two, which are the ones that I use, the order block and the breaker block, and then how to reduce the share of a POI to cash some good risk to reward trade. Take for instance, if you check for those of you who are if you check my X now, you see a trade that I caught on a distance. I think here is it. Like this trade, this was a one ratio. This first one was 1:97. By the second list, it was 1:100 and something. Together was 1:217 for just this particular trade. And the both of them smashed TP. I think that should be in the correct section. Yeah, this was the after for those trade particular. This is the after. Then for I think another one was here again. That should be okay. That was on JPY. Yeah. So this was the before. I think this was a 1:70, 1:40, something like that. And this was the after. This kind of trade 1 ratio, that should be 1:40 now. Or no, this was more than 1:40, either 1:70 or something like that. But this kind of trade, your $100 would have been $7,000 with this trade alone. Why this one over here, your $100 would have given you 21,000 dollars, right? But if you go with let me say if you even if it's $10, that would have given you $2,170. So $100 would have given you $21,400, something like that. So that's you can those are the kind of risk to reward trade you can be cashing. Now, this particular risk to reward trade that I caught here, this trade is a kind of trade that many people would have called this trade, let me say, using a 1:4, 1:6. In that case, they will only be getting $50, $60 back from the market. But because I've advanced my market mechanics, I'm able to cash trade even using 1 pip. Take for instance, these two trade here. If you check it very well, they are both 1 pip. Look at it. 6160.2, then the other one 6161. That's what it means. I only went higher by one. That was the SL. So it was just 1 pip. That means the exact point of reversal. That was what I used in cashing this trade. You can see it before here. The same thing. Okay, this not the before. Okay, over here. That's it here. 6160.2, 6161.2. This was the before. Just 1 pip entry of a till and all that. So those are the kind of trade you can be cashing. And when you're cashing trade with such small pips, that simply means that your risk to reward ratio will be very high, right? That's why you can see me cashing those 1:70, 1:30, and all that. So with that being said, let's get started with our this today. So let's talk about the theory behind points of interest. What is the theory behind points of interest? So I've actually talked about this already, but I will come again. Now, when we're dealing with basic market mechanics, like I said, we explain it using two concepts, which is we're explaining using the first one that's the supply and demand, while the second one was smart money concept. Now in advanced market mechanics, we'll be using the smart money concept majorly. Now you already know fully well that the smart money guys are the people I want to follow, right? We want to follow their blueprints in the market, their footprints and all that. So we don't just rush into the market blindly. We tend to follow other people. We don't follow patterns that often. We just tend to follow whatever blueprint or footprint is particularly guys left for us, right? So with that being said, let's talk about the theory of behind this point of interest. The theory behind it is that these points of interest are areas in the market that you most likely see your smart money guys position, right? So it means that all these levels, there are levels in the market that you will be seeing that we saw these massive orders that are being filled by smart money. You will see that the initialization stage is mostly at all these levels, right? That's why it is regarded as the point of interest that we use. That means we SFC traders, we use those points of interest because those are the levels we feel like smart money guys will be using to enter the market. Now, with that being said, that does not mean that that is the exact level they use to enter the market. Just that that is the level we feel that those smart money guys will most likely be positioned, and it is something that will be tested over and over again. That's why you see a lot of people, even up to now, they use other blocks, breaker blocks, and all those ones, right? But for the case of this they will be make use of other block and breaker block, with other block being the major one, because that's the one that I use mostly. Then accompanying it with breaker block. So that is the theory behind the points of interest. It's not too much. It's just that we try these are levels in the market that we one that most likely see your smart money guys position. That is the essence of the breaker. That's the essence of the points of interest, right? So just have it in mind that it does not have to be perfect. It does not have to be perfect. It does not have to give you the perfect this thing. No, it's just that that point is here. Your smart money guys will be positioned in the market. That means when price is coming back, it's around this level that you see your smart money guys ready to do what? To reverse to market. That is, it is now that they feel more settled to do or to enter the market. So we want to trade the same time with them. That's why we use all this thing. And if you check, it's something that you always see. Anytime you see a should I say a reversal in the market, right, or any point of rejection, check properly. You see that that particular point of rejection was we got that point of rejection because there's a market mechanics at that particular level. There will surely be one at that particular level. Perhaps not on that time frame, but on a different time frame, you most likely see it. So that's for that. Now, let's talk about what actually validates the points of interest. Because if you check the market, well, I tell you, there are a lot of them in the market. A lot. Take, for instance, just in a particular market, you most likely see multiple other block at that particular market. Take, for instance, using this one for example, you see your other block here. You see your breaker block here. You see your other block here. You see your breaker block here. So out of all this for now, what exactly or what actually validates all these points of interest to be used as well as you know actually validated to be used as points of interest that we want to look into. This is where the separation comes in the sense that in a validation, the first thing you want to look into first is the trend. Remember, when it comes to the market, the first thing you want to look into first is the market structure, which is the trend of that market. It is the most important. There's nothing far more important than the structure, the trend of that market. The trend of that market is the most important one. Never you go and do analysis without looking out for market structure first. You must make sure that you are with the trend. So that's what you want to look out for. Because if you're not with the trend, take for instance now, this breaker block, why did this place fall into a breaker? Because this was a supply zone. This one has faced a supply zone. But why did it fit to hold? Was because it is not in line with the trend. This point of interest here is not in line with the trend. The trend is an uptrend, and that was why price did what price broke that particular one because it's not in line with the trend. Supply zones are for downtrend. It's when we're in a downtrend, that's when you most likely see this one working, something like this, in which market will now be breaking demand to buy because we're not in a demand trend. So the first thing we want to look at for first is the trend. Now, another thing again you should look at for is after the trend is the criteria for that particular trend, which is your break of structure or your market structure shift. You want to see it first. You want to see your break of structure, your market structure shifts. Which means that your point of interest must have triggered a break of structure, a market structure shift before. This is what I mean. Take for instance, this particular order block meets up the validation because why? It has given us a market structure shift, a break of structure at this particular level. This breakout block as well give us a break of structure. Yes, so the both of them actually are correct. Right? I'm not saying supply zone, I said breakout block because supply zone is no longer in need anymore. Supply zone have already been disrespected. It's a breakout block land to use to continue the work to buy. The same thing here. This one, based on the validation, this one is correct. This one as well is correct. That means the 4 points of interest they are all correct based on the validation that it must give you a break of structure or a market structure shift. All of them here give you a break of structure, right? So now, what is the next thing that actually validates it? The next thing that actually validates it most likely be the presence of a fair value gap. The presence of a fair value gap is actually crucial because fair value gap is what actually brings market back. Remember, fair value gap is what indicates that, okay, there's an impulsive move in this particular place. That means the market was put off balance at that point in time. So when market is off balance, it means that you most likely want the market to come and balance it. And that is why market will come back and fill in that fair value gap to tap into your breakup block or your other block before pushing to the other side. So you want to see the presence of a fair value gap or an impulsive move, any of those ones. Now, since this is not a candle chart, we can say that all of them have impulsive move of a thing. You can see after this an indication of an impulsive move, all these ones. So all of them literally have impulsive move, right? Now, apart from that, the next one now, like I said, the three breakdown that I gave to you, that means market structure. With this, we are done with market structure, right? We're done with market structure. We're not moving over to market mechanics. That's why we're not using fair value gap as what as a validation for this point of interest, right? Now, it does not mean that each and every one has to have a fair value gap. Just an indication that there's an impulsive move there, be it an engulfing candlestick and a golf candlestick, I mean to say rather. So that's for that. Now, the next thing you want to look at for in market mechanics is correspondence with an higher time frame point of interest. Take for instance, here in the 15 minutes time frame and you're looking for your point of interest in the 15 minute time frame. You find another block. Now you want to make sure that other block is correspondent with an higher time frame point of interest, be it another block or a breaker block, before you can then say that, okay, let me use this particular other block. All right, that's it for, it might be that's of the 1 hour, it might be that's of the 4 hours or 3 hours. And so far that time frame is higher than one you are working on. All right, you want to see the presence of something there that will most likely make that your points of interest to actually hold. All right, so that's for that. Now, the next thing, the next validation for it, which is the most important one, with this, we're done with market mechanics for the validation. Now, the third one is liquidity. This is where the separation comes in. This is where basic SMC, excuse me. So this here, basic SMC differs from advanced SMC, the application of what? Of liquidity. All right. Now, liquidity, which I've already been taught, is that this year, the main essence of smart money is being mentioned because smart money, guys, one of the major things they do is that they hunt for liquidity. Why did they hunt for liquidity? Because in the market is an uptrend. Now, for the case of this, for the purpose of this class, I've only been using uptrend, just so that the opposite goes for a downtrend, right? That means I'm only using the demand trend, but the opposite goes for a supply trend. Okay. So now, let's say in the case of an uptrend now, your smart money guys want to enter the market. Everybody have been buying. That's why markets have been trading to the upside. Now, since everyone have been buying, there won't be adequate sellers in the market to actually fill in just because for someone to buy, there need to be sellers in the market. Now, it's when there are few sellers, that's when the remaining sellers will now be selling at an higher price, thereby driving price to the upside. That's why whenever there are many buyers in the market, what will happen? price will rise to the premium level because people are interested in that particular thing. So they will no longer be a discount anymore. They'll be selling at premium. Normally, in our normal business society, when there are a lot of people interested in a particular thing, what happens? They'll be selling at premium. That means they will increase the price to actually maximize profits. So almost the same thing happens here, but just that it's a different concept when it comes to this side. All right. So now that's exactly what push price higher. We already talked about this when we're talking about supply and demand in basic market mechanics, right? When we're explaining market mechanics based on supply and demand. So that's for that. Now, you need the other party for the other party to stay strong. There's no way one can work without the other one. Without sellers, there won't be buyers. Without buyers, there won't be sellers. That's the essence of liquidity. It's when there are adequate buyers and sellers when we can say that these markets have what? Liquidity. Not the liquidity I'm talking about when it comes to smart money though, but smart money, now this is it. When there's one this thing, there's like one lacks, like one party lacks, there's the other party is inadequate. One is greater than the other one by far. That's when you most likely see your impulsive move to the upside, right? So when such happens, we can see that the market is not balanced because liquidity is not evenly distributed. There are a lot of buyers than sellers. So in this case, your smart money guys should then be the ones to more or less restore order to the market directly or indirectly. In which they most likely try to fill in their orders. Now, for smart money guys to fill in their orders, they need added because you know that smart money guys they fill in orders they fill in big amounts of orders, not just little orders, they fill in big amounts of orders. So you want to make sure that your smart they want to make sure that there are a lot of sellers in the market before they can be able to fill in their buy orders. There should be adequate sellers. If the sellers are not much, your smart money guys cannot fill in their orders. So because of this, they will have to bring work on the market, more or less known as the manipulation move. So make the market, to make your buyers start selling. So there will be a lot of sellers, that there will be adequate sellers in the market, or make some buyers force quit their buy position. On a force quit their buy position, it means that they're selling off. Take for instance, I bought something, right? I bought I bought fuel. Now, fuel in the market have reduced. All right, fuel in the market have reduced. The price of it have reduced. Now, the price of fuel was now okay. I bought at a normal level when I saw that price of fuel is about to increase. All right, but let me just use the financial market. Let's talk about the crypto market. Take for instance, I bought BTC when BTC was moving to the upside. So I bought BTC at 100,000. Right now, BTC then rose to 130,000. Because of that, many people are just buying. There's no one to sell. So what will then happen? It's time to restore balance to the market. That's when they will start bringing the price down so that those that are buying will start selling. They start selling. Now, me that is holding BTC already, what will happen? I will feel like, this thing too much. Like, see the way my profits are supposed to collect for 130K, don't drop come 120. You don't drop come 115. That pressure, make me want to sell off. So keep some profit for for myself. And when I first quit, when I sell off that my this thing, when I exchange my BTC, simply means that I'm doing what? I'm selling it. And when I sell, many other people will be selling as well, thereby making the smart money guys to be able to fill in their order at that point in time. So you can see that the smart money guys need us. They need us to fill in their orders. And that's why it's good that we that want to follow the smart money guys always look out for liquidity. Because if we don't look out for liquidity, we end up being the liquidity for the smart money guys to actually fill in their orders, right? So we want to look out for liquidity at any point in time. And based on our last class on the complex this thing, we'll be able to complex liquidity. We'll be able to talk about the various type of liquidity we have in the market. We have the inducement, we have the trendline liquidity, we have the engineering liquidity, and we have the ranging liquidity. All of them are the types of liquidity that you can actually use to do what when you want to cash your trade. Majorly, I make use of inducement, which is the first pullback after a break of structure. Now, let's come back to this. This is the break of structure around here. After this break of structure, this break of structure actually gives us a pullback which is this pullback, actually gave us a what? A break, another break of structure again to the upside. Now, by giving us this second break of structure to the upside, thereby means that this thing is now valid to be used as a what? As an inducement. If you remember the validation of an inducement, please, for those of you that don't know what even this one, check the video before this one. You will see inducement, but in that one, please. Amen. So you will see inducement in that video. Check the previous videos. That means I think that should be day 9 or so. No, that should be day 10. Yeah, day 10. You will see the video there about inducement. So you see the break, the pullback, the first pullback, and what validates it is that you must take out at least 50% or 70% of the pullback to validate an inducement or give you a break of structure, which you have done here. So this will now be then be used as the what? As inducement. Now, for me to say that this will be used as the inducement, it means that those that will enter their trade here, they are to be used as liquidity. Those that will be entering their trade here, that will be used as liquidity. So with that being said, these 2 points of interest, this breaker block and this other block there, have now been invalidated. That means they'll be violated. They won't stand anymore. These two now, they are not out because they now will be used as liquidity for the market. People have been entering the trade, entry markets here. People have been entering markets here. All of them will be used as liquidity. And those that have already entered market here and here, like anybody in around this particular circle now, let me use as what? Liquidity. So you want to avoid these places. Don't trade from your inducements, all right? So you mark this place as your inducement, and then with that being said, we then be left with these 2 points of interest now. So with this, you can be able to see that we have taken out these 2, only to be left with these 2 points of interest from just the validation A known. All right. So with that being said, let's move over to the next one. So this is how you validate your listing. That means that when price is coming down, price will either use this breaker block here, tap here, then push to the upside, or use this other block here to do what? To push to the upside. These 2 are valid to do what? To hold price. Just make sure that the other validation are in place to actually tell you which one in particular to use. So now let's move on to our order of points of interest, which is the advanced PDR array. Now, we already know our PDR array before. If you don't know, go back to our complex market structure. That's where we talk about PDR array. One of the videos where we should talk about rejection and the fair value gap. Yeah, check among the days. I think that should be day 4. That should be day 4. Yeah, when we talk about rejection and fair value gap. At the beginning, we actually discussed about PDR array first. So go and watch it to know the basic PDR array before we move on to the advanced. Now, the advanced is how the PDR array are being distributed in the market, right? How the PDR array are being distributed in the market. They don't just appear in the market. They are distributed in a kind of order. They have an order at which they are being distributed. That means the order at which price will react to them. So now, with that being said, let's come back home a little bit. Now, let's take, for instance, we have something like this. We all know that this is a downtrend, right? Now, after this downtrend, what happened next was an impulsive move to the upside. This impulsive move, okay, let me just end it here. So here's our break of structure, right? Now, many of you might have ended up with something like this in the market before, ended up in such a situation like this. It's time to make it clear, right? So now, in cases like this, there are multiple points of interest here. Take, for instance, we have a breaker block here. We have a breaker block here. We have another breaker block here. We have another breaker block here. Before we then come to this other block at this particular level. Now, what is the order of the points of interest? First of all, remember the validation, your break of structure first, which we have seen here, or rather your market structure shift. In this case, this is a break of structure, so BOS. Now, this is our break of structure to the upside. So, first of all, markets will have to come and retrace back, right? To come and pick up orders before pushing to the upside. At what order does market do so? Market does that in an orderly manner. The market is not a ruminant animal. So, until market gets to its destination, let me say, sorry about that. Let me say this market destination over here, right? So, until market gets to this destination, until market gets here, before reversing the trend, because market needs to reach before the trend reversal. So until market get to this particular point, or you can keep on taking your norm from any of all these points of interest. All right. Now, what's in what order? First of all, the pullback will come to this level first, which is the first breaker block. The first breaker block, first of all. Oh, sorry about that. Now, from here, market will push to the upside. Now, if market push to the upside and still fail to reach its destination before coming back, let me use this one instead. Like I said, now if market failed to push to this upside before coming back, then know that this place will then be used as the liquidity. The reaction from that breaker block will then be used as the liquidity for the next points of interest to do what? To hold. Are you seeing it now? So this is the order at which everything is being done. Now, if these points of interest actually work and price still fails to get to its destination, then this reaction from this other block here will then be used as the liquidity from this breaker block, I mean to say, then be used as liquidity for these points of interest, which is the next one, the next breaker block, to actually do what? To hold. Now, if this one still fails to get to that particular destination, journey. Now, at such point, there's already a change in trend initially before market got to this, perhaps around this particular level. Side. So that breaker block, right? So that's for that. So from here, for you then see market pushing to the upside. Okay. So this is it for the order at which market this thing is being done. You can see first of all this first breaker block before the second one, before the third one, and before this fourth point of interest. So this is the order at which the point of interest is being used. So that when you get to the market, you won't confuse yourself on which point of interest to use. Just know that you want to pick the points of interest that is closer to liquidity. That is one of the rule of advanced SMC. The point of interest that is closer to liquidity should be your points of interest. If it's a breaker block, it should be the breaker block. If it's another block, it should be the other block. All right, that should be your points of interest. Or depending on the one that you want to use, because later on you have to everything here. You still need to go back to the market to go and do your research and look for the one that suits more better with you before you can then start using them. So after this, enter the market, go and make your research. Really, after that liquidity of it, liquidity is something that is broad. I cannot one class. No, go and make your research. When I say research, it means that go and back test, enter the market, enter the chart, go and back test it very well. Know which one is actually working before you start using it. All right. Everyone we have, we usually come up with different ways. No one can actually come up with the same this thing. Everyone is different. Everyone is unique to themselves. So everyone can come up with different ways that really can kill the market. The model I'm giving you is something very easy and very easy to to bend, not to curve, but yet you still be on the right path. All right. So that's for that. I think with this, we're done with the order at which point of interest is being, um, you know, it's been done in the market. So let's talk about the next thing. Now, our next thing is reducing the share of the points of interest. This is one of the most important things when it comes to advanced market mechanics. This is the most important, reducing the share of your points of interest, because this one will be the one to actually give you, and this is the most risky one among them. It is the one that will actually give you all this high risk to reward trade of thing and all that. Normally, all these ones that I'll be doing so far will actually give you an high risk to reward. Take for instance, instead of you to come and pull your this thing here, instead of come and pull your this thing here, you have done what you have reduced it to now this level. Now, what we want to, based on the liquidity concept already, you know that okay, it is this breaker block that we want. We call that we just make use of the breaker block. So your trading say be 1:1 before, dot some 1:5. Or you will most likely know that okay, it's the other block that we hold, and from there your trading is supposed to be just how many dots on 1:8. All right, with this, $100 will give you $800. All right, so that's it. So all these five I've already been doing things that will help you reduce it. So, but instead, let's move down to what's actually how can we reduce our points of interest. Now, how can we reduce our points of the chef of our POI? The chef simply means that, take for instance, if I'm to go to the higher time frame, my other block will most likely be like this. If I pick another block from the higher time frame. So how do we reduce that this thing to actually look for the perfect other block that will give you that sniper entry of a thing and all that? Take for instance, in the case of my own, which is something like this. How can we get the perfect order block to actually get all this trade? All right, that's where this particular thing comes in. Now, in the higher time frame, you most likely see your this thing around the air. You mostly see your order block around the air. Yeah, no matter if you use to make analysis or perhaps the higher time frame, you mostly see your order block there. Now, after marking down that order block, it is time for you to go down to the lower time frame. With that being said, let me use a practical example, a life example for this particular. I think I have this. I actually took this trade though. One of my students gave me this sweet setup, currently in massive profit set as we talk. Say this, but not need to stress yourself. This is a perfect one ratio. Meaning when we say cash, this odds, whatever, this odd night ability. That's it. Now did I well, not be time to advance yet. We'll leave that one for later. But this something I can actually do. The normal standard 1:59. So let's go back to what we are here for. Um, okay, I want to reduce the distance of the share of the points of interest. Let me go back to the 4-hour time frame. Now, let's say in the 4-hour time frame. Now, in the 4-hour time frame, let me make use of this. You can see this breaker block here, this supply zone here, this is a breaker block. All right. So now in this time frame, this is the distance. So if I'm to take this particular trade, what will happen? My points of interest will not be, my trade will not be like this. So my IC will not be big like this. Most of the time, most like want to cover up this thing. So trade say suppose give me over how many, will come give me just 1:2. But after picking my points of interest from the 4-hour time frame, I'll go back to the 1-hour time frame. Now, in the 1-hour time frame, what I will do here is that I will look for the exact point, the exact market mechanism that will be inside that is closer to liquidity. Remember, this is the liquidity over here. These are liquidity. All right. For the higher time frame, these are liquidity. So I look for the the point of trade that is closest to liquidity. And in this case, you can see that it is this breaker block here that is closer to liquidity based on the 1 hour time frame. It is this breaker block here. Now with that, let's check the new updates. And I have a 1:14 trade, right? And I have a 1:14 trade. But not only that, I've reduced it from a 1 ratio. How many was it again? 1:5, I've been 1:3, I've been 1 ratio something something. So 1:14 already. But that's not enough. Depend on how far you advance yourself, reach, and that will determine just how much of the advancement you can do. Now, in my case, I can let's say, okay, let me take it from here, from this top here, which is actually a breaker block. Now, when I take it from that top there, what will that happen? Let's check. And I have a 1:27 trade, risk to reward ratio. All right. Now, this thing is not so, we don't need to go deep into it. It's something you need to advance all by yourself. All right. So you need to advance all by yourself. And you don't need risk to reward ratio of the thing. I'm just doing this so that I can be able to maximize your profits. That does not mean you should be greedy. Because most of the times when you start narrowing down this your point of future of a thing, you most likely end up with a lot of misentries or getting stop at as easily as possible. So it is not advisable. Only for those on an advanced level. Take for instance, and me, you not get back to me say, I want to carry 1:2. Which I want use and do. Most of the times, majority of my trade are above 1:10. Then if I want to go crazy with the market, that's when we see 1:30, 1:40, 1:100, and all that. So that's for that. Now, even this, I will still advance my points of interest. You know me before. I will still advance my own, whether market like it or not. I don't like easy thing. For the perfect sniper, well, for now, your limit should be the one. Your limit should be the 5 minute time frame. Now, what happened here? Please watch your before the higher time frame break or structure of a thing. What happened? Market give us a little break or structure in this one, this thing in the lower time frame. So you just need to bring back your market mechanics over to this side again. Your old rules, all the rules, you need to bring them back here. All right, that will be our last class, putting everything together. So you will bring everything back here to actually pick the perfect one. Then from here, this is the liquidity. This is the break of structure, and this is the pullback after. So this is my main. This should then be my main liquidity. I'll be protecting my points of interest. As you can see my fair value gap there already. That is in correspondence with this breaker block. Now, if I want to be greedy, very much greedy, I can be very greedy. I trust myself. I'll just take the body. So it just depends on how you want to play around with the market range. And with that, let's go. Forget that I'm doing this with something I've already played at though, but this is something I catch normally with the market. Those of you that in our community, you should know this by now. So taking this only and the final result for this trade that was supposed to be in 1 ratio something, it then become a what? In 1:133. Now, what was the main this thing in the 4 hour time frame? That was 1 ratio, was it not 1 ratio something 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 1:2, I've been 1 ratio. It was here now. Yeah, that was a 1:2 point something. So 1:2 point something means that your $10 will give you a $20. But now your $10 will give you 1,300. No, yeah, yes. Your $10 will then give you 1,330 something dollars instead of $20. You have multiplied it by how many? By over like you have multiplied it by over 50, if not more than. I think that's almost over 30. If I would say that over 75, yeah, you have multiplied your profit by 75 times. That means over 7,500% plus added to it. So this is you can do what? You can narrow down your points of interest. You can reduce the share of your points of interest to start getting some good risk to reward trade. All right. So I think this will be the end of the class for today. We actually spent a lot of time in this particular thing, but it was worth it. This is something that I'm not supposed to, give out for free. All right. But other people are looking for ways for me to actually navigate this Forex market. That's why I'm making this mentorship free. So if you are just joining us, pay a little bit to subscribe and all that. So that other people that are looking for a way to navigate the Forex market will be able to see all these videos and then, drop your like and comment so that YouTube can be able to recommend these videos for other persons and all that. So with that being said, that will be all for today's class. Time for questions. For those of you that have questions, I beg go and also finish one question today, Sha. So you can ask your questions. Do you guys have any question? Or you want rewatch the video first because that's what I always do. And I want you always rewatch video first before I do anything. Any question regarding to this class?
No.
All right. All right then. So that will be the end of our class today. The recording will be made available very soon. Good night, everyone.